15 Tax Saving Strategies for Individuals. There are numerous tax saving strategies are available to individuals, including using registered accounts, claiming eligible tax deductions and credits, and taking advantage of income splitting opportunities. The best approach will depend on your personal financial situation and goals. Number 1. Use tax-advantaged investment accounts like Registered Retirement Savings Plan or RRSP. Contributions to an RRSP are deductible and reduce your taxable income for the year, which can result in a tax refund. The money in the account grows tax-deferred until you withdraw it, typically during retirement when you are in a lower tax bracket. For 2025, the maximum contribution limit is 18% of your 2024 earned income up to a maximum of $32,490. Unused contribution room can be carried forward indefinitely. You can also withdraw funds from your RRSP tax-free under the Homebuyers Plan or the Lifelong Learning Plan, provided you follow the repayment rules. Number 2. Tax-free savings account, TFSA. A TFSA allows your investments to grow tax-free, and you can make withdrawals without paying any tax. For 2025, the annual contribution limit is $7,000. While contributions are not tax-deductible, withdrawals do not affect your eligibility for income-tested government benefits like the Goods and Services Tax, GST credit. Your TFSA contribution room is the sum of the annual dollar limit, any withdrawals made in the previous year, and any unused contribution room from prior years. Number 3. First Home Savings Account, FHSA. The FHSA allows qualifying first-time homebuyers to save for their first home on a tax-free basis, combining the benefits of both an RRSP and a TFSA. RSP is tax-deductible contributions. Your annual contributions are tax-deductible, reducing your taxable income. Tax-free withdrawals. Withdrawals to purchase a first home are tax-free. Number 4. Registered Education Savings Plan, RESP. An RESP is a plan to save for a child's education. Tax-deferred growth. The money you put in grows tax-deferred. Government grants. The federal government adds money to the RESP through the Canada Education Savings Grant, CESG. Flexible tax treatment. When funds are withdrawn for educational purposes, the investment income is taxed in the student's name, who is typically in a lower tax bracket. Number 5. Childcare expenses. Deduct costs paid to have a child cared for so that you or your spouse can work or go to school. Moving expenses. If you moved at least 40 kilometers closer to a new job or school, you may be able to deduct eligible moving expenses. Number 6. Home office expenses. Self-employed individuals and employees who work from home may be able to claim a portion of their home office expenses, including utilities and rent. Number 7. Investments. Certain investment-related fees, such as management fees for non-registered fee-based accounts, may be tax-deductible. Capital losses. You can use capital losses from non-registered investment accounts to offset capital gains and reduce your taxable income. Number 8. Claim available tax credits. Tax credits directly reduce the amount of tax you owe, dollar for dollar. Number 9. Medical expenses. Claim a non-refundable tax credit for eligible medical expenses that exceed a certain threshold. Number 10. Charitable donations. Get a non-refundable tax credit for donations made to eligible registered charities. The credit is higher for total donations over $200. Number 11. Tuition tax credit. Students can claim eligible tuition fees. Unused credits can be carried forward or transferred to a spouse or parent. Number 12. Principal residence exemption. The capital gain on the sale of your primary residence is typically tax exempt. You must report the sale on your tax return to claim this exemption. Employ income splitting strategies. Income splitting can reduce a family's overall tax bill by shifting income from a higher earning spouse to a lower earning one. Number 13. Spousal RRSP. A higher income spouse can contribute to their partner's RRSP. This allows the funds to be withdrawn later by the lower income spouse, who will be taxed at their lower marginal tax rate. Number 14. Pension income splitting. Couples can elect to split up to 50% of eligible pension income. Special considerations for the self-employed maximize business deductions. Self-employed individuals can deduct most reasonable expenses incurred to earn business income. This can include home office expenses, vehicle expenses, and business-related supplies. Number 15. Consider incorporation. Incorporating your business can offer significant tax advantages, such as lower corporate tax rates on profits and opportunities for income splitting. Keep meticulous records. Maintaining excellent records of your business income and expenses is essential for claiming all eligible deductions and preparing for potential audits.